Equity markets reversed some of the gains made since the start of the year, as economic indicators pointed to a slowing of the economic recovery. Recent economic data has been disappointing relative to consensus, as the momentum for growth is waning. OECD leading indicators have come off their peak, while the global purchasing manufacturers' indices have also moderated. In emerging economies, there are also signs that the recent tightening by central banks is softening activity. The dispersion between the recoveries in countries continued in the first quarter, as the lacklustre recovery continued for debt-burdened countries such as the UK and Spain, while the export-driven German economy continued to flourish. Bond markets made gains in Europe as the core government bond markets, most notably Germany, benefited from the flight to quality. The yield on the German 10-year government bond fell below 3% as markets reassessed the amount of interest rate increases that the ECB are expected to make. Eurozone peripheral bond markets, on the other hand, remained stressed as the yield on Greek, Irish and Portuguese bonds continued to increase. Corporate bonds traded in line with government bonds in Europe and added over 1%. Commodity markets were extremely volatile in May, particularly the precious metal and energy sectors. Market sentiment changed abruptly for commodities, which saw oil plummet by $10 per barrel in a day and silver drop by 12%. Disappointing economic data from the US and Germany triggered the move, while the strength in the dollar also dampened sentiment. However, the scale of the moves was exaggerated by nervousness among the large number of speculators that had built up positions prior to the collapse in prices. Commodity prices stabilised towards the end of the month, but failed to recoup these losses. The ECB meeting in May resulted in volatility in currency markets. President Trichet failed to signal to the markets that they would increase interest rates in June, as had been expected. As a result, markets are now predicting that the ECB will raise interest rates at a much slower pace than had been expected. The slower economic output also resulted in a decline in inflation expectations. Consequently, the euro also weakened substantially since the start of May, despite a rally in the last week of May. The sovereign debt crisis in Europe continued to escalate, especially as it became evident that Greece's fiscal consolidation efforts are off track for 2011. The EU will be required to provide extra funding to Greece, or else Greece will be left with no alternative but to default. It appears that despite the political unwillingness in Europe to give additional funds to Greece, a default at this stage could prove more costly to the Eurozone banking system as a result of contagion to other peripheral economies.